There's a lot of comments out there about the interview, 60 Minutes interview yesterday, talking about this, the book, talking about what Michael Lewis was talking about in that, hey, is this a market rigged? He says it is. He talked about high frequency trading. If you don't understand that and you've got a question about it, you can ask me. But that's what he's talking about. And he said, the market's rigged. They're just driving. There's nothing illegal about it. They're certainly looking into it. But that's just one tiny little thing. I don't know that the market's rigged, but I believe it's manipulated. There's no getting around that. It has been for the last 10 years, but when it all shakes out, usually the winners and losers are pretty accurate. But it's very, very interesting if you look at what is happening within corporate insiders, you find out that, rigged or not, corporate insiders are sellers, not net buyers of stock, corporate insiders. Now, they were corporate insiders were right in 2007 to be net sellers. I was a net seller. I was just blessed by the Lord in having that foresight and was able to get out. I got out a lot. I went about 40% cash in late 2007 after Bear Stearns went down, and it did go down. After Bear Stearns went down and got bailed out in March, I was about 70% cash. So I rode into the storm 70% cash, so I did fairly well. But there were a lot of corporate insiders that did the same thing. And now they're doing it again, and nobody seems to care about it or paying any attention to it. But who do you trust? Do you entrust some person on Wall Street to make predictions about a particular company? Do you expect me? Do you trust me to make a good pick on a stock more than you would a corporate insider? Let's say you knew a senior VP at a big oil company. Would you believe what he said about their stock, or would you believe what I said? If I were you, I would believe what he said. He's intricately involved in that corporation and their activities. He's got a better feel than anybody else does. But we're not going to pay attention to that. And there's no reason to pay attention to it from the standpoint that, listen, do we care about the fundamentals of the economy? I think this market has clearly sent the message that the fundamentals of the economy are irrelevant in this day and age. When in fact, since the inception of the market, the fundamentals of the economy have been exactly the only thing relevant, because it was the fundamentals of the economy that drove the market. The economy was good. People had jobs. People were spending money. People spending money means they need more goods and products and services. When that happens, companies boost production to sell more. When they boost production to sell more, they hire more people, expand their plants, creating more jobs. And when they sell more goods, they make more money that goes to their bottom line, and their stock price goes up. It's the way it's always been. You can talk about it and go, if you want to go back through all, I have all my old economic books. I mean, if you want to go back and search through all that stuff, that's fine. But that's how it's always worked. So, all of a sudden, it doesn't work that way anymore. All of a sudden, since 2010, all of a sudden, since the Fed. And let us not forget, folks, that the Fed has, regardless of what they do with this QE, which we're now at 65 billion. That's wonderful. We're reducing the amount in which we print. That's a wonderful thing. The problem is, let's not forget, they've got over $4 trillion on their balance sheet. They've got to get at least $3 trillion, in my opinion, off. Maybe even a little more than that. But they've got to get just over $3 trillion off the books. How are they going to do that? Is that going to cause a disruption in the market? Well, not if the economy is thriving, it's not. Not if the markets are thriving as a result of a thriving economy. It may not cause a disruption if they do it gradually. But if the numbers aren't real, at some point in time, it's got to catch up, because you've got to stop pedaling the bike at some point. And when you do, it's going to fall over.